Let's talk about accounts payable. If you have a cash basis taxpayer, would you expect to see accounts payable on their tax return? I'm going to say no, because remember, cash basis, you don't have an expense until you actually pay it. If you've paid it, you don't have an account payable. You've already paid it. So accounts payable is an accrual basis account. Now, will you come across 1120S tax returns for cash basis taxpayers that have on the prior year an ending balance in accounts payable? 100% you will. Should you? No. What do you do if it's there? You can correct it as part of your end of year stuff. But you will see it. You shouldn't, though, because accounts payable is an accrual basis account. Go ahead, Sean.
Good question, because I see this sometimes, particularly from larger CPA firms, where they do everything on accrual and then they have a timing entry
They do everything on accrual in the books or on the tax return.
in the books, and then they do
Yeah.
a timing entry to back out cash adjustments.
Yeah. So, like I said, it is highly possible to have a cash basis taxpayer that keeps their books on accrual basis or that has a modified accrual basis. So, it is not uncommon to see accounts payable in the books for a client that is cash basis. And I'm going to use QuickBooks as an example, other softwares might be similar, but I'm not as familiar. In QuickBooks, if you run a balance sheet on cash basis, it will not include accounts receivable and it will not include accounts payable. If you run it on accrual basis, it will. Now, whether you should use, I've heard some people say that the cash basis reports out of QuickBooks aren't accurate if they're doing accrual basis activities like creating invoices and recording vendor bills. I have not found that to be the case, but then again, my clients are all very simple. What a lot of CPA firms do is they will have the clients provide them with accrual basis reports, and then they'll do an accrual to cash work paper to move those books from accrual basis to cash basis, and then they use the adjusted their work paper cash basis balances and all of the accounts to prepare the tax return. I have, and there might be on the Pronto tax platform an accrual to cash adjustment. I feel like we talked about this before. So, Imelda, if you know for sure, maybe you can link it. But either way, when you guys go on your platform, you should be able to search like accrual to cash. If you don't find one, let me know. I have a work paper. We generally don't do it. Most of our clients are cash basis. We're doing after the fact bookkeeping, meaning we're not even recording transactions in the books until they hit the bank account. So for those clients, the cash basis reports and the accrual basis reports look exactly the same. Where you might want to test it is if you have a client that is generating invoices in QuickBooks or that is recording vendor bills, you may want to run the reports in accrual basis, go through that accrual to cash adjustment process, and then compare that to the cash basis reports in QuickBooks to see if they're accurate. But got kind of in the weeds there. Short story is you shouldn't see accounts payable on a cash basis taxpayer's tax return. What about mortgages, notes, bonds payable in less than 1 year? That account to me seems pretty self-explanatory, right? If the client has a loan and the loan matures within the next 12 months, that's going to be recorded here because it's payable in less than 1 year. Technically, and I'm going to call myself out again, we generally don't do this, but technically, that is also supposed to include the current portion of long-term debt. So let's say the client has a loan that's payable over the next 5 years. Technically, the tax return should reflect the balance that's due in the next 12 months on line 17 and the rest on line 20. So one loan would be reported in 2 places. That's the technically correct way to do it. Y'all, I'm not going to tell you not to do it. I'm going to tell you that's the technically correct way to do it. What you do with it from there is up to you. So it's really easy if the loan clearly matures within the next 12 months, no question, right? What about other current liabilities? What might be included in other current liabilities that's not an account payable and is not a note or a bond payable within the next year?
Credit cards.
Yep, credit cards are an example. That's probably the most.
Payroll, some
Payroll
sort of state,
liabilities.
FICA, FUTA, whatever.
Yep. Payroll liabilities and credit cards are the two most common items that I see in other current liabilities. Um, yeah, I mean, I think that's good enough. What about loans from shareholders?
Completely used improperly.
Probably. I'm a little bit less offended when I see a loan from a shareholder than when I see a loan to a shareholder. Loan to a shareholder, in my experience, 9 times out of 10 means they avoided capital gains tax. They took too much in distributions and their taxpayer tap danced and called it a loan. Loans from shareholders means the shareholder has deposited personal money into the business. Now, there should still be a loan agreement, right? If the company is borrowing money from someone, even a shareholder, there should be a loan agreement at arm's length with stated interest and all that normal stuff. I'm a little bit less offended if I see that. When an S corporation shareholder deposits personal money into the business, there's a few different ways that it could be recorded. It's either a contribution, right, which would be other paid in capital, or it's a loan. Typically, those are the two main, right? They're either loaning money to the company or they're just contributing it and they'll get it back someday or maybe they won't. So a loan from shareholder doesn't offend me. I would expect to see a loan agreement with an amortization table because these accounts should still be getting reconciled. These should be in the books. Those accounts should be reconciled. Interest should be recorded. So you really should have all of those documents. Now, whether you collect those, so here's a matter of practice. When you have a client, when you're doing, let's say you don't do the bookkeeping, you're just doing the business tax, not just, you're doing the business tax returns, you don't do the bookkeeping. Do you require your clients to give you year-end bank statements and year-end loan statements to confirm balances when you prepare the return? Sean's nodding his head yes. Marley's nodding yes. A couple other people are nodding yes. I will confess, I don't always. I think for me, it's kind of a judgment call. If I know that their bookkeeping is a hot pile of garbage, then yes, I'm going to require documentation. But if I know their bookkeeping is pretty on point, I might let it slide. I would say that if you're not collecting those year-end documents, like the December loan statements, the December bank statements, you may want to consider making that part of your business tax workflow because as you'll learn in future sessions when we talk about issues making the balance sheet balance, if your client, for example, hasn't reconciled those loan accounts, then you might have a disparity. They might not have recorded the right amount of interest, which won't allow the balance that they recorded to tie, which won't allow the balance sheet to tie. And so as you're troubleshooting why you can't get your balance sheet to balance, you may end up needing those statements anyway. So you might want to make that part of your early season flow is to request those statements.
Thanks for watching. If you found this session helpful, we invite you to join our Pronto Tax School memberships. You'll get access to weekly live mentor support sessions like this one, plus tons of advanced tax course trainings, private groups, special discounts to in-person events, a tax business growth coach, and so much more. Check the links in the description to learn more about our Dream Team and Forever Edition memberships, and join us today.